Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of August 14th. Last week, we saw more evidence that the Fed's aggressive rate hikes are slowing inflation. CPI, the Consumer Price Index, came in lower than expected. And as you see here, whether we look at trailing 3 months, 6 months, or 12 months, disinflation trends continue. And then PPI, the Producer Price Index, which is a proxy of business costs, last week came in a little higher than expected, but the prior month's June reading was revised lower. When you take all this together, PPI has increased 0.8% over the past 12 months, very disinflationary. The good news is that unless we see some surprises on the inflation front, the Fed is likely on hold for the rest of this year. So this sets the stage to what we're watching for this week. The Fed meeting minutes are to be released from the last meeting, which was on September 25th and September 26th. These meeting minutes get released on Wednesday. As a reminder, after each Fed meeting, minutes are released exactly 3 weeks later. So if we go back to the July 25th and 26th meeting, the Fed raised rates by 0.25% after pausing in the June meeting. So from the meeting minutes, we want to learn 3 things. Number one, the rate hike back in July was surprisingly unanimous, but we're seeing so much evidence that inflation is slowing down. And this was especially evident in the June CPI report, which was released 2 weeks before the Fed meeting. And that showed CPI lower than expected and at its lowest level since March of 2021. The Fed raised rates. So we want to learn any comments about this disconnect between inflation slowing and the Fed raising rates. Second of all, there's all this debate in terms of where the Fed views what level of rates become restrictive. In other words, slows the economy down, and how long it takes the impact of higher rates to affect the economy. Well, is there any discussion on these topics? We want to learn that. And the third thing we want to learn is that in the press conference after the July meeting, for the first time in about 18 months, Powell did not warn about further rate hikes. His tone was pretty different. Was this on purpose? Was this an accident? We'll learn more about this in the meeting minutes. So the key takeaway, unless data surprises, especially inflation surprises on the upside, we feel the Fed is likely to pause for the rest of this year. Inflation is slowing, credit conditions are tightening. In other words, it is harder to borrow money. This is evidenced by the banking crisis, by the senior loan officer surveys, which are pointing to more tightening lending conditions, and the Moody's rating agency that downgraded banks just a couple weeks ago. Normally, when we see this, the Fed starts cutting rates, but because services inflation is still high and inflation is not yet at the 2% Fed target, expect rates to be higher for longer. Takeaway is that Fed is pausing, but maintaining a higher for longer bias. Thank you for listening. For more information, please follow us on Twitter at CeteraIM. See you next week, and thank you.